Money moves the world, but wherever money flows, deception follows. Over the last century, some of the largest financial scams in history didn't happen in dark alleys or offshore islands. They happened in plain sight, inside boardrooms, banks, investment firms, and even trusted government systems. What makes these scams truly dangerous isn't just the billions of dollars lost. It's the fact that most victims never believed they were at risk. They trusted the system. They trusted the institutions. They trusted the people in charge. From Wall Street legends to crypto hype machines, financial scams evolve with technology, regulation, and human emotion. Greed, fear, urgency, and authority are the same tools scammers have always used, just packaged in more sophisticated ways. In this video, we break down the 5 biggest financial scams, how they worked, why so many intelligent people fell for them, and most importantly, how you can protect yourself from becoming the next victim. The Ponzi scheme. The scam that never dies. The Ponzi scheme is the most infamous financial scam in history and the most successful. Named after Charles Ponzi in the 1920s, this scheme survives because it exploits something deeply human: trust mixed with the promise of easy returns. At its core, a Ponzi scheme is simple. There is no real investment. Early investors are paid using the money from new investors. As long as fresh money keeps flowing in, the illusion survives. The moment inflows slow, the entire structure collapses. The most devastating example in U.S. history was Bernard Madoff. For decades, Madoff presented himself as a financial genius, former NASDAQ chairman, and trusted advisor to charities, pension funds, and wealthy families. His reported returns were stable, consistent, and suspiciously smooth, even during market crashes. Behind the scenes, there were no trades, no strategies, no secret algorithms, just bank accounts moving money around. Madoff's fraud exceeded $65 billion, making it the largest Ponzi scheme ever discovered. What made it dangerous wasn't complexity, it was credibility, prestigious reputation. Word-of-mouth referrals, only exclusive access, consistent returns regardless of market conditions. People believed that if wealthy institutions trusted him, it must be safe. Warning signs: guaranteed or unusually consistent returns, difficulty withdrawing money, lack of transparency, or third-party audits, pressure to reinvest profits. How to avoid it: never trust returns that appear immune to market risk. Legitimate investments fluctuate. Always verify custodians. Demand independent audits. And remember, if returns sound too smooth, something is being hidden. Crypto and digital asset scams. The modern gold rush trap. Cryptocurrency promised decentralization, transparency, and freedom from corrupt financial systems. But it also opened the door to one of the fastest-growing scam categories in modern finance. From fake tokens to rug pulls, crypto scams exploded during bull markets, especially between 2020 and 2022. The collapse of FTX shocked the world. Marketed as a safe, compliant, and sophisticated crypto exchange, FTX was backed by celebrities, venture capital firms, and political connections. Its founder portrayed himself as a responsible innovator. In reality, customer funds were secretly used to cover losses at a trading firm tied to the same founder. There were no proper controls, no separation of assets, no transparency. When confidence disappeared, billions vanished almost overnight. Other crypto scams include rug pulls. Developers abandoned projects after raising funds. Fake staking platforms, influencer-promoted pump-and-dump tokens, imposter wallets, and phishing attacks. Why people fell for it: fear of missing out, FOMO. Technical jargon creates false legitimacy. Celebrity endorsements, lack of regulation, warning signs. Anonymous developers, unrealistic yield promises, locked liquidity controlled by developers, no clear business model. How to avoid it: if you don't understand how value is created, don't invest. Never trust yield without risk explanation. Use reputable platforms, cold storage when possible, and assume hype exists to benefit insiders first. Fake investment advisors and affinity fraud. Affinity fraud is especially dangerous because it targets trust within communities, religious groups, professional networks, military families, and ethnic communities. Scammers pose as successful insiders who look like you, talk like you, and believe what you believe. That shared identity lowers skepticism. Victims believe, he wouldn't scam us, he's one of us. These scams often involve Fake hedge funds, real estate syndications, retirement investment pools. Scammers create polished reports, fake statements, and even small initial payouts to build confidence. In many U.S. cases, retirement savings of entire communities were wiped out before authorities intervened, often years too late. Warning signs: exclusive, community only, investments. Pressure not to tell outsiders. Lack of SEC registration. How to avoid it: never let trust replace verification. Check licensing through official regulators. If secrecy is encouraged, walk away. Financial legitimacy does not rely on relationships. It relies on documentation and oversight. Predatory loans and debt traps. Not all scams are illegal. Some operate legally while destroying lives. Predatory lending targets financially stressed individuals, offering quick cash with devastating long-term consequences. Payday loans, subprime auto loans, and certain mortgage products fall into this category. During the 2008 financial crisis, millions of Americans were sold mortgages they could never afford. Adjustable rates reset higher, fees compounded, and foreclosures followed. Lenders understood the math. Borrowers often didn't. Red flags: high interest rates with complex terms, balloon payments, no clear explanation of total cost. How to avoid it: always calculate total repayment cost. Avoid lenders who discourage questions. Seek credit counseling when necessary. Convenience today can become financial slavery tomorrow. Online impersonation and AI-powered fraud. The newest scams don't require persuasion. They require deception. AI-generated voices, fake emails, cloned identities, and deepfake videos now mimic banks, employers, and even family members. Scammers impersonate IRS agents, banks, investment firms, or CEOs requesting urgent transfers. Losses from online impersonation scams in the U.S. now exceed tens of billions annually. Warning signs: urgency and threats. Requests for secrecy, payment requests via gift cards or crypto. How to avoid it: always pause. Independently verify requests. Banks don't threaten. The IRS doesn't demand instant payment. When urgency replaces clarity, assume fraud. Government impersonation and tax scams. When authority becomes a weapon, few scams are as psychologically effective as pretending to be the government. Authority discourages questions. Urgency overwhelms logic. Fear replaces reason. In the United States, government impersonation scams have become one of the fastest-growing sources of financial losses, targeting everyday Americans, small business owners, retirees, and immigrants alike. These scams often involve impersonating the IRS, Social Security Administration, Medicare, state tax agencies, law enforcement departments. The message is always structured the same way: you are in violation. You owe money. You must act immediately. Victims are told they face arrest, frozen accounts, property seizure, or benefit termination if they don't pay right away. The payments demanded often include gift cards, wire transfers, cryptocurrency, peer-to-peer payment apps. Why? Because these methods are difficult or impossible to reverse. One of the most common variants involves IRS tax debt scams. Scammers send convincing emails, texts, or automated calls claiming the recipient owes back taxes or missed a filing deadline. The language is aggressive and intimidating, designed to trigger panic rather than analysis. In reality, the IRS never initiates contact via phone, text, or email, demands immediate payment, accepts gift cards or crypto, threatens arrest over the phone, yet thousands of Americans still fall victim every year. Another rapidly growing variant targets Social Security recipients. Victims are told their Social Security number has been compromised or that benefits will be suspended unless they verify their identity or submit payment. For older Americans, many of whom rely heavily on monthly benefits, this threat feels existential. Why these scams are so effective? These scams succeed because they exploit fear of authority, lack of familiarity with government procedures, time pressure, isolation. Victims are instructed not to contact anyone else and warned that the case is confidential. This isolation prevents intervention by family members or trusted advisors. Small businesses are also frequent targets. Scammers impersonate state authorities, claiming unpaid fees, expiring licenses, or regulatory violations. Busy owners comply quickly to avoid disruption, only later realizing the agency never contacted them. Real-world impact. According to official U.S. data, Government impersonation scams cost Americans billions of dollars annually, with seniors over 60 experiencing the highest per-person losses. But the financial loss is only part of the damage. Many victims report depression, shame, loss of trust, withdrawal from financial decision-making. Scammers count on this emotional silence to escape detection. How to protect yourself? The most effective defense is knowing how real government agencies operate. Key rules. Government agencies send official letters by mail first. They do not demand immediate payment. They do not threaten arrest. They do not request unconventional payment methods. If contacted, pause. Disconnect. Verify independently using official phone numbers, not those provided by the caller. Fear disappears under verification. Business and employment scams. How work became the bait as remote work expanded across the U.S. Scammers found a new opportunity: employment itself. Job scams are now among the most reported financial fraud categories, affecting job seekers, freelancers, contractors, and even experienced professionals. These scams often appear legitimate: professional websites, company logos, LinkedIn profiles. Fake HR representatives conducting interviews. The offers are attractive: high pay, flexible hours, remote work, immediate hiring. Victims are told they've been selected quickly, sometimes without an interview at all. Then the fraud begins. One common scenario involves fake equipment purchases. New hires are told to buy computers, software, or office supplies using company-issued checks or reimbursements. The check later bounces, but the vendor payment is irreversible. Another variant is payroll diversion scams, where scammers pose as HR departments and request employees update direct deposit information. Paychecks quietly get rerouted to fraud accounts. Freelancers face a different danger. They are hired for projects, deliver work, and never get paid, while scammers resell their labor or data. The most dangerous versions combine employment fraud with identity theft. Victims submit resumes, social security numbers, banking details, and IDs, handing criminals everything they need to steal identities at scale. Why these scams are increasing? Several trends have accelerated employment-based scams. Remote hiring reduces face-to-face verification. Online job boards are easy to exploit. Economic uncertainty makes people vulnerable. Speed is prioritized over diligence. Scammers understand desperation. When people need income, skepticism drops. Red flags to watch for job offers without interviews, requests for upfront payments. Payment via unusual methods, pressure to act quickly. Emails from non-corporate domains. Legitimate employers do not ask employees to move money, buy equipment independently, or share sensitive data before formal onboarding. Business email compromise, BC. One of the most costly employment-related scams targets companies themselves. In BC scams, criminals gain access to corporate email systems or spoof executive accounts. Employees receive requests that appear to come from CEOs or CFOs asking for urgent wire transfers or invoice payments. These requests are often urgent, confidential, perfectly timed. U.S. businesses lose billions annually to BC scams because employees assume the source is legitimate. Defense strategies. For individuals, verify job offers independently. Research companies through official websites. Never pay to get paid. For businesses, implement dual approval payment systems. Train employees on verification protocols. Treat urgency as a red flag, not a priority. The deeper cost beyond financial losses. Job scams erode confidence in digital employment ecosystems. Victims become hesitant to apply, work, or trust. In an economy built on flexibility and digital trust, that damage has long-term consequences. Insurance and healthcare fraud. The scam you pay for without knowing. Insurance fraud is one of the most expensive financial crimes in the United States. Yet most Americans don't realize they are paying for it every single year. Unlike classic scams where victims knowingly send money to criminals, insurance fraud often hides inside legitimate systems. The losses are quietly passed on through higher premiums, higher deductibles, and reduced coverage. Health insurance, auto insurance, disability insurance, and Medicare are all major targets. In many cases, there is no single victim who reports the crime. Instead, millions of policyholders collectively absorb the cost, making this one of the hardest scams to eliminate. How insurance fraud works. Insurance fraud typically falls into two categories: hard fraud, deliberate fabrication of claims; soft fraud, exaggeration, or manipulation of real claims. Examples include billing for medical procedures that never happened, upcoding, charging for more expensive treatments than provided, staged car accidents, fake injuries, duplicate claims across providers. Healthcare fraud alone costs the U.S. hundreds of billions of dollars annually, according to long-standing estimates by regulators and policy analysts. One of the most severe forms occurs in Medicare and Medicaid fraud. Criminal networks exploit the scale of government healthcare programs by submitting massive volumes of fake claims before detection systems catch up. Patients often don't realize they're involved until benefits are exhausted. Medical records show treatments they never received. IRS or government agencies initiate inquiries in some cases. Victims are recruited knowingly. Offers of free medical testing or cash in exchange for using insurance information pull people into fraudulent networks, exposing them to legal risk without understanding the consequences. Why it's so difficult to detect. Insurance systems rely heavily on trust and volume. Millions of claims flow daily. Even small success rates translate into massive profits for fraudsters. Technology has improved detection, but criminals adapt quickly. Rotating business names using shell clinics, exploiting telehealth billing loopholes. Meanwhile, legitimate patients face denied coverage, increased out-of-pocket costs, higher premiums year after year. The system becomes more suspicious, even toward honest users. The hidden victim, you. Even if you never commit fraud, you pay for it in several ways. Rising premiums, reduced coverage options, stricter claim approvals, longer dispute processes. Insurance fraud acts as a silent tax, one most Americans don't know they're paying. How individuals can protect themselves: always review insurance statements, question charges you don't recognize, protect insurance ID numbers. Avoid free medical offers tied to insurance use. Fraud thrives in complexity and indifference. Transparency is its enemy. Data monetization and financial surveillance. When your information becomes the product, one of the most powerful financial scams in modern history, doesn't feel like a scam at all. It doesn't steal money directly. It doesn't demand payment. It doesn't trigger alarms. Instead, it extracts something far more valuable over time: your financial behavior, preferences, and vulnerabilities. In the digital economy, personal financial data is worth billions, and much of it is collected legally, quietly, and permanently. The illusion of free financial tools many Americans now use: budgeting apps, free credit score services, cashback platforms, buy now pay later apps, zero fee investing platforms. These tools appear consumer-friendly. They promise empowerment, access, and convenience. But behind the interface, many monetize user data in ways customers never fully understand. Your spending habits, debt levels, income timing, risk tolerance, and financial stress patterns are extremely valuable, not just to advertisers, but to lenders, insurers, and pricing algorithms. Data brokers aggregate information, combine it with external data, and resell insights that shape decisions affecting credit offers, insurance pricing, loan approvals, interest rates. The consumer rarely sees this process, but they feel the outcome. Algorithmic harm. Algorithms don't need to be malicious to cause damage. When financial models infer high financial stress, impulse spending, limited savings, income instability, they may quietly increase pricing. Limit offers push higher interest products, reduce options. This creates a feedback loop where vulnerable consumers receive worse financial terms, deepening inequality. Dark patterns in financial apps. Some platforms use behavioral design to push users toward debt. Default minimum payments, frequent credit limit increases, delayed cost transparency. These techniques are legal, but manipulative. The consumer believes they are in control, while design nudges dictate behavior. Why this is a scam in everything but name. Unlike traditional fraud, this system doesn't break the law. It exploits information asymmetry. The user agrees to terms they cannot realistically read or negotiate. Data sharing becomes normalized. Consent becomes symbolic. The extraction is slow, cumulative, and invisible. And once data is collected, it is replicated, resold, stored indefinitely. Opting out later doesn't reclaim the past. How to reduce exposure. Limit unnecessary financial apps. Review data sharing permissions. Use privacy-focused tools where possible. Avoid platforms that profit primarily from user data. Convenience should never come at the cost of autonomy. Across every scam examined in this series, Whether it involved billions lost in boardrooms or quiet losses hidden inside apps, the pattern is unmistakable. The most effective financial scams aren't built on lies alone. They're built on momentum. They move faster than skepticism. They replace verification with urgency. They present complexity as sophistication and trust as protection. Every scam, no matter how advanced, relies on the same human vulnerability: the belief that this system is too legitimate to fail, or this person wouldn't deceive me. But history shows something different. Scams don't disappear as society becomes more educated. They evolve to match technology, regulation, and culture. When trust concentrates, whether in institutions, platforms, software, or personalities, risk follows. And this is the most important lesson. Financial safety is not about intelligence. It's about discipline. Discipline to slow down. Discipline to verify instead of assume. Discipline to ask uncomfortable questions. Discipline to walk away when clarity is missing. In finance, opportunity is never rare. But capital is fragile. Those who survive aren't the ones who chase every return. They're the ones who protect what they already have. In an economy designed to move fast, caution isn't fear. It's awareness. And awareness, over time, is the most reliable investment you can make.